In medicine, our outputs are directly connected to our inputs. That's why I think educating yourself financially is so important, because once you figure out the right strategy for your long-term why, eventually you're going to hit a point where your outputs will become disconnected from your inputs.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris, and today's guest is Dr. Yatin Chadha. He's a Toronto-based radiologist and host of Beyond MD, a popular podcast helping physicians and other high-income professionals build real estate literacy. He blends clinical credibility with clear, practical education, from corporate structures and estates planning to investor-level decision-making, and he's now expanding into concise radiology courses for non-radiologists. So super excited to have you here, Dr. Chadha. I'm going to call you Yatin for the sake of our interview today. I appreciate you being here. How are you today?
I'm doing really well. And Neil, Clint, thank you for having me on the show.
Absolutely.
Thank you so much for being here. So you've got that, we were talking before we started recording, that rare breed that I love to talk to because of my background in 16 years working as a medical sales rep in cardiology, that sometimes you find that blend of that white coat professional that is a healer, that's taking care of people, that also has that business acumen, oftentimes two different sides of the brain. And so I love when we can find that together in a way that is creating obviously value for you, but also for the people around you and the people smart enough to listen to you. So tell us about your background, how you got started in medicine, and what led to you having, influence and looking at things like corporate structure and building Beyond MD.
Thank you for that question. So my path was originally one of tunnel vision. I decided from a very young age that I wanted to be a doctor like my dad. And I decided that when I was maybe 5 or 6. My dad was a family doctor. He was enjoying his work and he was a great dad, always with us. And so I wanted to follow in his footsteps. And I would say, while that tunnel vision allowed me to get to where I wanted to go within medicine, guys, I will say that it blocked me from a lot of other experiences along the way that could have shaped my life positively. So when I started practice in 2016, it was really pedal to the metal, just getting comfortable with clinical practice. And we moved from Alberta to Toronto for family reasons in 2017. And then when COVID hit, I had 1 month where, not by choice, I only worked 4 days. And I'm typically not somebody who does while sitting idle. And around that time, my interest in personal finance had been growing. I had been talking a lot to my accountant. I'd been talking a lot to a few other colleagues who were interested. And then it just hit me. I was taught none of this information in school. Everybody was asking me questions. I had the same burning questions about how to build a better life for myself and support my family. Yet I knew none of this knowledge. And so I told my wife that day, I said, I have an idea for creating a podcast. Why don't I invite subject experts onto my show? And why don't I learn along the way? And why don't I just share what I'm learning with the world? That's how Beyond MD was born, my podcast. And that day, my wife told me, you overthink everything. Promise me you're not going to overthink this. Just go out and do it. And so I did it, ordered myself some equipment, and the rest is history. We're 5 years in, we're over 100 episodes in, and it's become a really important part of my identity. I've learned an incredible amount along the way. I've networked, and it's really brought me closer to my clinical colleagues across Canada. And it gives me joy because I feel like I am adding real value. And so that's how Beyond MD started. And I think over the last 5 years, my interest in all topics financial literacy has only intensified. I'm very passionate about investing in the markets. And I know we're going to talk a bit about real estate today. The reason I decided to get into real estate investing was I'm somebody, I don't like to put all my money into one type of investment. So the markets, I like to have things that are a little bit uncorrelated with one another. And then the other thing was, as doctors in Canada, we are able to incorporate our medical practice. So most of my income is into my professional corporation, a company, and that's what I earn through medical practice. And then I can decide how much do I want to bring to myself personally, but whatever I retain inside the corporation, I can figure out, well, do I want to put that into the markets or do I want to put that into real estate, which for some people can be a very powerful way to save and grow wealth over time. So that's a snapshot. I know there's a lot there and we can go any direction you want to.
there's a lot to dig into, and there's quite a few things there that we've never talked about, and that I'm really excited to dig into. So congratulations on your success. I think we're 155 episodes in on this one, and it's amazing. I used to say, if you really want to learn about something, listen to a podcast, and I don't believe that anymore. You really want to learn about something, start a podcast.
Yeah, I agree with you.
Turns you into a lightning rod for some really amazing conversations.
I agree with you, and congratulations to you guys as well for all the episodes that you put out. And I one thing I found that for my community of medical professionals, a lot of our learning is actually done on the way to work because we're very busy. And so for me, that platform of podcasting, it really hit home for me. And I think that's why it really resonates within our medical community too. But congrats to you guys as well.
Thank you. Man, listen, this is great. Listen, I want to talk to you about, I would really like to jump into the corporation side of things. For the high earner income professionals with a corporation, like there's some core building blocks that you've been very intentional about with what you've learned about and the way that you've structured things. Can you just give us a basic overview of the corporate structure that you're implementing, and just people kind of get the landscape of the land that we're about to dig into?
Yeah, absolutely. So there's one thing that I believe in. I talked to a group of people about this yesterday, some medical residents, but it's the wealth formula. And I think the wealth formula is fairly simple. So ideally, you want to be earning a healthy income. And we in medicine, in most specialties, we are quite fortunate to earn a healthy, stable, recession-resistant income. So you have the earning side of things. And then we want to be spending money on the areas that are important to us in life. So for us as a family, we spend on our house, we spend on private school for our kids, and then we travel as a family to create experiences that are going to compound over time. I try not to spend heavily in all other areas because otherwise my spending is going to catch up to the amount that I earn. So if I can create that differential between what I earn and what I spend, then I have that corporate structure. And I ideally want to be investing as much of that differential as possible. So what happens for us in Canada is, I would say around 80 to 85% of us, we have incorporated our medical practice. So our medical income goes into a business entity called our corporation. And then from the corporation, we can decide, well, how much do we want to turn that tap on in terms of moving that money to ourselves personally for all those personal expenses? And how much do we want to retain inside that corporation? Because if we're able to retain more, that retained income is usually subject to a lower tax rate. You're deferring tax. Eventually, one day you're going to have to pay it, but you defer tax and you allow more to accumulate inside that business entity, and then you invest it however you wish. So I will use that to invest into stocks, into ETFs, and then into real estate. And what I've kind of done is, alongside my corporation, I have a second company, which is a holding company. The money moves from the corporation to the holding company. It's a intercompany transfer that does not incur any tax. And then I use the holding company to invest in everything real estate related. Now, the reason I have it separate from the corporation that brings in money from medical practice is because I want to detach any risks that come with rental properties from my medical income. So let's say something happened to a tenant, something happened to a property, there was a complaint, then those assets are detached from the corporation that earns the medical income. And so that's how I have structured things. It's a great way to control how much money you bring to your personal hands for your expenses. And then it's a great way to defer taxes, leaving you a larger pool subject to a lower tax rate that you can deploy as you wish, including real estate.
Okay, so the holding company is only holding the real estate assets. It's not also holding the equities and ETFs.
Yeah, so great question. Great question. So our provinces here in Canada, they usually have their own mandates about what they're okay with you investing your corporate assets in. And so most of them are okay with stocks, ETFs, bonds. Not all of them are okay with us deploying those funds into real estate. And then just as a more, I guess, common sense approach, just to separate the risk that can come with owning properties directly from our medical income, that's the second reason that many of us will open up a holding company.
Gotcha. And when you talk about real estate, you mentioned rental properties. Is that what you're investing in? Direct ownership rental properties? You're investing in syndications? What sorts of real estate do you invest
Great question. So I can start off with my rental properties. And how it all started was in 2019. My sister, who's a family doctor in the Toronto area, she was looking for a place to rent. And she asked me, she's like, can you come and just check out some properties with me? And then I started to see uh, the units that were available. We were checking out condos at the time. And I promise I may start off a little bit negative, but then things will turn positive here. But in a lot of our larger Canadian markets, we've had low vacancy. So usually under 3%. And I saw what these rental rates were going for. Rents are very expensive in Canada. And so I thought to myself, well, maybe a condo is interesting from an investment perspective. What if I buy one for myself as an investment? And then let's see if I can get X amount of rent, then it may make it worthwhile. So I got quite interested in starting out rental property investing that way through condos. So I started in 2020. I had actually found a pre construction that was going to be available at around $775 per square foot. That sounds very expensive, but in Toronto, back then in 2020, we had people investing in properties at 1,500 per square foot. The highest I heard was $1,700 per square foot. And so then I was kind of steered towards something in our downtown core at $1,200 a square foot by somebody we knew, and they labeled it as a screaming buy. I didn't really know anything better at the time, so we invested in that. Looking back, I probably should have stuck to my guns and just gone with the property that was in the inner city in an area that was undergoing gentrification and still is, because you have potential for more increase in the condo price. But anyways, that was our first investment. We just closed on it. The truth is, it is cash flow negative month to month right now. I picked up another condo in Kitchener-Waterloo, which is one of Canada's fastest growing areas. The mistake I made with that one was when I was doing my numbers, running the numbers, I did not account for interest rates going as high as they did between 2022 and 2024. And so that was cash flow negative as well. And then I started listening to a few podcasts, started to educate myself. I listened to Bigger Pockets, Brandon Turner. And one thing I learned through those was everyone, they seemed to be doing really well, but they were taking a different approach. A lot of it was multifamily investing or maybe a short to midterm rental. And then I connected with one of who I think is the godfathers of multifamily investing in Canada, somebody you could even consider for your show, Quentin D'Souza. He's a school teacher who actually ended up creating a 9-figure real estate portfolio. And he told me on that call, he said, Yatin, why don't you focus on markets which you truly understand? He said, Kitchener-Waterloo is a great area to start, but what else do you know? And I thought back to my hometown where I grew up, Kingston, Ontario, 3 hours out of Toronto, a city of 150,000 people, which had a top tier university and 2 hospitals. So I started to look there, found a few triplexes, got my dad, who still lives in the city. My parents are there. I got them to go look at the property. He called me right away. I was on a call shift. He said, Yatin, I think you're going to want to see this place. And so I looked at the pictures, the inspection report. We kind of went through the numbers. And then I found out that with the current rents, which were under market, and even budgeting for an interest rate of 6%, that I would easily be cash flow neutral on this property. And so I told my wife, who was heading away on a trip, I said, I'm eyeing this property, still doing some due diligence. And then the first night she was away, I picked up the phone, I called her, and I told her, you know that property that I was eyeing? And she said, yeah. And I said, well, I actually ended up buying it. She freaked out. But anyways, it ended up being a phenomenal cash flow positive machine. And it took a while to get there. You know, we had renos to do, we had leaky pipes, we had boiler issues, but it ended up getting to the point where it now flows about $1,500 of cash per month. And that was through multifamily investing. So those are my 3 rental properties. And for people wondering, why am I hanging on to my condos? Well, the cash flow from my triplex offsets the negative cash flow from the condos. And the investment thesis right now in the greater Toronto area is condos were overbuilt, but when interest rates went up, a lot of builders went underwater, and then nobody was building any units. And so the thesis is that in the next 3 to 5 years, we're going to have a supply shortage when there's still going to be a demand. And so I'm okay to still wait things out with my direct holdings. And so that's what I've done on the direct holdings. I have found that Multifamily, I believe, is superior to investing in condos because with condos, if you think about it, there really aren't many levers to pull. Ethically as a landlord, I found I can only raise my rent a certain amount. We have rent control in Ontario. Property taxes go up over time. Condo fees go up over time. There's not many levers to pull. But with a smart multifamily investment, you have more levers that you can pull in your favor. And so that's my outlook for rental properties and my experience. Happy to clarify anything there. And then I have done a fair bit of passive real estate investing that we can get into as well if you'd like.
Yeah, that lesson is something that we hear over and over from people. Like I've now got 2 quadplexes and a duplex. I had 3. I sold one of the quadplexes recently. But if you take any one of those 4 quadplexes, if I had 4 condos and I had 4 tenants, but I had 4 sets of fixed overhead in terms of mortgages, taxes, insurance, and HOA, it would break even at best. But one quadplex with 1 mortgage, 1 set of taxes, 1 set of utilities, but 4 rental units will cash flow 80 grand. It's so funny. It's really not about the number of units. It's about the unit density mix, and you've got 2 columns. In one, you have your number of fixed overhead payments, and then the other one, you have your number of rental units. If those are 1-to-1, it's really hard to get ahead. It's by grouping them together that you start getting, okay, yeah, I've got 1 payment here, but I've got 4 rental units, or 8, or 12, or 16 rental units. That's when you start creating the margin, and then you get a little bit of safety and security in terms of your unoccupancy. It creates a little bit more stability than if you have 1 unit that's empty for 3 months versus, that's a single family versus part of a quadplex or a triplex. Obviously, it creates some stability there. So
Economies of scale.
absolutely. And frankly, I'm surprised that you have that many active investments because you're that unique situation where your time is really valuable, right? There's only so much involvement that Yatin needs to have flipping properties or wholesaling or doing single family rentals. Like, you should be buying condos because there's less wear and tear and effort that needs to go into it if you're doing single family. But then beyond that, multifamily is obviously the better play. Are you the guy that should be going and buying a 60-unit apartment complex? I would argue that it probably makes more sense for you to partner with an operator on a 400-unit apartment complex because you get the economies of scale of having on-site management. You still have to have that combination of time, experience, and money to pull it off, but you probably don't have a ton of time. Without time, you can't get a ton of experience. What you do have is capital, and you are a high-earning income individual that's a white coat professional. I know that you're doing this because you love it and you're passionate about it, and you're clearly very good at it, but at some point, it's good to probably keep the main thing and not go do a job that you can pay somebody else to do for $50 an hour when your time is obviously worth significantly more than that. So, do you feel yourself getting pulled in the passive direction because of the offset of, like, you've got a pretty high ceiling over here with what you're doing as your main gig? So, how does that play out in your decisions?
That's a beautiful question. And this really segues into what we're going to talk about next. But my wife had told me the same thing. She said, owning rental properties directly is a lot of work. Like, granted, knock on wood, with my condos, I don't really get many calls about those. And I have a property manager for our triplex. But still, the emails come in, my bandwidth gets tested, and you only have so much bandwidth to give. So as I reflect on this, I probably should have listened to my wife earlier. And now I don't buy properties directly anymore, and I do passive real estate investing. And there's really 3 types that I do, and we can get into it as you wish. But I have 3 that I've taken part in. Do you want me to talk about those, or I'll let you kind of steer the conversation anyway? Yeah.
Before you tell us, because I have a feeling you're going to have the right answer for this. I have a personal opinion on this that most people that jump into passive investing get the first few wrong. And I don't mean picking bad opportunities or anything like that. When we are speaking to investors that are looking at our deals, I find that a lot of times people haven't really put thought into the goal that they're trying to accomplish for their family. And they're looking at the deal. And they're just like, oh, I like this deal in this city. Oh, multifamily or car washes, I want to do that. Or, oh, we really like the area. Or, man, I really like these guys. They seem like they're great guys. And a lot of times I feel like the question needs to be, what do my wife, my husband, my spouse, my partner, whatever, like, what are we trying to accomplish with our life for our children and the people that we care about, and work backwards from the goal. So before you tell us the 3 offerings that you did invest in, I'd love to hear your why. And did you Did you and your wife come up with your why ahead of time, or after you started investing, did you kind of get to the point of that? I have a feeling that you probably had the foresight to think about that. A lot of people don't. I didn't on my first one or two passive investing offerings. So what's your why, and why are you choosing the offerings that you did choose? And then we'd love to hear about them.
The why is a great question. I always do think about that to start with, but probably not as deeply as I should have when I started. Like for me, real estate is an asset class that will always be needed. Everyone is going to need a roof over their head. I think everybody has the right to a roof over their head. It's always going to be in demand. And for me, knowing myself, I am not somebody who will just mindlessly, not to say mindlessly, but just throw money at the markets every month without thought when things are ripping at all-time highs. For me, I like to be a little bit more thoughtful about that process. And given our ability to earn, which we're very fortunate and grateful for, real estate for me becomes a great way to accumulate savings. It's essentially forced savings. And if done the right way, you'll get a healthy risk adjusted return. And we can get into all that. So for me, all those reasons, I wanted my asset classes to not all move in the same direction. So I was looking for uncorrelated returns. I was also looking to expose myself to an asset class that is always going to be in demand. And then the third thing was, if I can team up with people who have been in the game for long enough and have that management track record, then I can take my skills, my energy, and my bandwidth, and I can dedicate it to what I do best day to day. And for me, that's educating in my medical practice and educating through my podcast. So that's my why.
Love that.
Love it. So talk to us about those early, what was your first passive investment? How'd you find out about it? And, I want us to talk about your reflection. We were talking about this right before we hit record, and we wish we'd record earlier, where you talked about recently you sat down and you did a reflection on your investing journey and what's gone well and what hasn't gone well. So I want to get into that, but let's start with that first passive investment that caught your eye and whether it went well or what, and if it didn't, what lessons did you learn?
Yeah, absolutely. So the first passive type of investment that I started was through private equity and real estate development. So we have a few companies here that have been in this space acquiring land. They will be doing the zoning and the planning and then teaming up with a builder to construct either condo towers, townhomes, or other types of multifamily. And so some of these companies have been around since 2007, 2008. So I always look for that track record. But the first investment opportunity that I took part in was a passive investment into development of condo towers in the west end of the Greater Toronto area. And when I look at that, what went well, we picked a company that, one, had a track record. Two, they team up with builders that typically have very healthy balance sheets. So when you enter a period of time where interest rates go through the roof and the pre-construction condo market is literally imploding, you have a developer and a builder that as a team are able to wait things out, wait for some of the dust to settle, and wait for things to improve in the landscape before putting those condos for sale. So picking the right team was I think a really good thing that we did. However, when I reflect, nobody has a crystal ball, but maybe the writing was on the wall a little bit. We had so much construction of condos happening that maybe investing into a condo-based project wasn't the best way to go. So that was my first one. And, the returns that we were quoted at the time were probably in the 15% range annualized. I always like to encourage everybody, just give yourself a bit of a margin of safety. When somebody gives me a return, I will automatically trim it by a few percentage points. So this one I kind of knocked down to 10, 11%. And that's exactly where we're sitting right now in terms of projected returns. Now, what I started to learn a little bit more about was, can I invest passively through these same teams into other areas of the real estate market. So it turns out that some opportunities came up in the US. These were based in Atlanta. So what these companies were doing was they were buying older, large apartment buildings where the rents were vastly under market and the units needed to be upgraded. So they would acquire the building at a good price. They would go in, fix up the units, raise the rents, and then the expected turnaround time for this whole process is 3 to 5 years. And so that has gone quite well. And I think the reasons that is going well is one, it's a different style of investment where you have a few more levers in your control. When you're upgrading the units, you can maybe control your costs a little bit. You're investing into an area that doesn't have as many rent controls. And then three, Atlanta, like a few other areas, I'll use Alberta as an example in Canada. These are areas of the market where you have a rent to income ratio that is quite favorable. So when the rents are raised, let's say 4.5%, 5% a year, that is an increase that these renters can take on because their incomes are still at a very healthy level relative to the cost of living around them. So these types of projects have gone well, and the returns have actually increased from what we were quoted to start with. But I think passive real estate investing through real estate development, I think it's a great option for busy professionals who clearly have a skill set in another area. You can invest passively in real estate, but I think it's really important to invest in the right types. So I personally am steering away from condos right now, and I personally am going towards markets that have these attractive features. They're growing in size. They have a rent to income ratio that is quite favorable, and they don't have as many rent controls. So that's kind of what I'm looking for, and that's what's working for us right now.
I love that. I agree. I think anybody with a heavy value add strategy has a few more levers that they can pull versus someone that's just doing development. Like with development, you're building from the ground up. It's going to take you a couple of years to do the entitlement, permitting, engineering, and construction. And at the end of the day, the valuation of the units is the bricks and the sticks and what the person next door paid for theirs and what the demand is in the market. And you're hoping to time it right that at the end of this 2.5 to 3 year project, you're exiting it the right way. Versus somebody with a heavy value add strategy, they can renovate more, renovate less. What you're trying to do there is you're forcing that NOI. You push that net operating income up, and that's going to really, it hits a multiplier and creates value in the property. So that value add strategy is like when you're building a condo, the cost is the cost, right? The cost of development and everything else like that is pretty much, it is what it is. Material costs have gone up since COVID and everything else. When it's heavy value add, it's really about your basis. Like that's your opportunity to buy it right. It's like when you flip a house, you don't make your money when you sell it. You don't make your money when you renovated it. You made money when it smelled like dogs and cats and you bought it for dirt cheap. In this scenario, you bought it when it's a working class housing that's under market rent with deferred maintenance. That's where you make your money. It's actually on the purchase up front and it's heavy value add. And it's an existing cash flowing project versus new development. You got several years of interest only payments, sometimes variable rate interest only payments that you have to get through. And when those interest rates shot up higher and faster than they ever have in history at the end of 2022, that really changed the fundamentals on development and you had economic headwinds. And I think you're exactly right. Real estate is a forgiving and patient game. And even though those may not be, like even your individual condos may not be where you want them to be right now, we've just been through this wild fluctuation with interest rates going up, cost of capital going up, development costs going up. A lot of people slowed down on new projects. It's going to take a little time for supply and demand to catch up and for there to be the absorption in the market. But my suspicion is that Canada's got the same thing going on that the US has got going on, and that we are still in a housing crisis and we are 9 million units behind where we are supposed to be. So yes, we're having volatility, but if we give it time, it's a forgiving place. And I mean, I've seen in my own family real estate deals where people look at it and they're like, wow, you did great on that. That's a great deal. No, they actually overpaid and it was a horrible deal. They just held it for 30 years. And the market is very forgiving. And if you wait long enough, everything looks like you purchased it right. right? So, I mean, there's
Guys,
that.
I have to say I love that perspective, and there's a lot of experience coming out in your
Thank you for
explanation
jumping
there.
in.
Sorry.
Yeah. No, 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 no. I love it. And one thing, the only thing that reminded me of one thing I've been taught is with these projects in real estate development, I've been encouraged to think about this process as a margins game. Yes, you've got your price at the end, but when you've got more levers that you can control in the process, you can favorably dictate your margins. So think about it as a margins game, not necessarily like what's the price at the end of the road. That's why I like these projects where you buy something that needs to be turned around because there's more things you can control along the way. That's the only thing I'll add.
Yeah. And these days, a lot of times, multifamily, we're doing storage by buying old Kmart's and converting them. But like, you can buy properties right now for below the replacement cost. So you have that bulletproof basis that you can get a building for cheaper than you can buy the bricks and the mortar and have somebody put it together. So that's a basis that you can't get in new ground up development right now.
Now, Neil, Clint, can I ask you guys, is storage something like, is that your main area of focus today where you're putting in most of your effort? Because it's an area I'm also interested in learning more about.
That's all we do.
Yeah. So we've done a lot of other things. I've done single family rentals and flips, and I've got some small multifamily Airbnbs and a property management company. Through that process, I really got burned out with tenants, and I understand, like, I was going after financial independence, and I replaced my income of what I was making working in heart surgery. But the problem was, it was just financial. I still was basically on call and managing the managers of a company, and I had to be stuck in one location. And what I am really made a big shift to focus on is not just financial independence, but financial time and location independence combined to create an independent purpose. That is why I made the transition to storage, not because I'm a smart guy, but because I have great partners like Neil and Eric and Levi. And also because I talk to older, wiser people than me. And later on in life, everybody seems to migrate away from the wildly active strategies to the more passive strategies as your time becomes more valuable in your life. And the three areas that I had people continuously referring to me were hard money lending and note lending, and mobile home parks. And I was already burned out on tenants because of the short-term rentals, and storage. And storage is a box of air. There's no bathrooms, there's no kitchens, there's no one living in the property. But the key for me was the basis. We can build a self-storage facility for $130 a square, or we can buy an old Kmart for less than $20 a square foot and convert it into storage for $40 a square foot. And it's half the cost of new development. It includes the cost of the land, and it's in a faster time frame. So there's a very loose analogy to what you've got with your heavy value add projects in Atlanta. It really starts with the basis. If you can get the basis below the replacement cost, that's great. And outside of that, we like it because it's inflation resistant, pandemic resistant, and recession resistant. Nothing is proof, right? Nothing's recession proof, but we've had a slowdown in the housing market, and that's obviously affected storage as well. But that's why we like it, but different strokes for different folks.
Oh, great to hear.
I want to ask you a question. We naturally get sucked into the quagmire of talking about real estate all the time, but you've got experience in the world of corporations and corporate structure that we don't often get a chance to tap into on this podcast. So you've described a 3-layer tax hit when an incorporated professional has a death. Like, let me rephrase it this way. When you talk about you having a corporation and a holding company, it sounds great. And it sounds like something we could dig into, but usually things like that open up some kind of pitfalls. And this is an opportunity for us to talk to you and learn from your experience instead of us making our own mistakes. So once you're getting into the world of corporations, it creates a lot of beauty in terms of the tax deferment. But what are some of the things people need to be on the lookout or potential landmines that people may not see coming?
That's a very insightful question. I mean, thanks for checking out my content around the various layers of tax on corporations. But yeah, so we've talked about the benefits of incorporating, and the main benefit is you are deferring tax. But that means that one day you will have to pay tax after your assets have grown. And so today, one of the things that we have to be mindful of is the way in which we are investing. We want to make sure that it is ideally done in a more tax efficient way for our corporation. So I'll give you an example. One type of passive real estate investment that I have also taken part in is a MIC, a mortgage investment corporation. So that is a pool of mortgages that an accredited investor can take part in. And those will generate income based on the interest payments that the borrowers are making. And the type that I take part in, for example, it will yield 8% a year. But the way those are paid out is it's equivalent to an interest payment. An interest payment is not treated in a very tax favorable way inside your corporation. That's going to be taxed at 50 to 51%. So essentially, you're driving down your effective returns to 4% instead of 8%, which is barely edging out inflation. So that's why investments of this nature, I try to steer clear of these inside my corporation, and I will shift them over to a tax sheltered account. For us in Canada, it's an RSP, which is similar to like a 401k. So that's one thing. Today, I want to make sure that my corporate investments are more tax strategic. So what do I focus on? When it comes to, for example, equities, I will try to focus on equities that are a little bit more growth oriented. Because if I have a long-term investment approach, then I have unrealized capital gains that one day I will sell. And what happens is once you make the sale, let's say you bought something at $10 and let's say it's a 100 bagger, or sorry, a 10 bagger and it's $100 when you sell. You've got that $90 gain once you sell it. Half of that is going to be taxable to the corporation, but the other half actually flows into this notional account called your capital dividend account, and that actually flows into your personal hands tax-free. So orienting my investments in a way that are a little bit more growth oriented can be very tax favorable inside a corporation. The other thing I try to do on the real estate front is any project that I'm taking part in, I want to know what is the tax treatment of the returns that I'm going to receive. So sometimes it's return of capital, and if done in the right way with people with a track record, that can be very tax efficient for a corporation. I try to steer clear of distributions that are treated as interest payments. That's not tax favorable for the corporation. And the other thing is some will actually give you income that is treated as business income. And if we arrange things in our corporation in such a way, that business income gets treated favorably at a much lower tax rate than our top personal tax rates. So that's what I do today. And then there's a question of later on, what do we have to do? We have to make sure that we understand when we pass away, our corporations are going to be hit with various layers of tax. And I had a podcast on this recently. There can be up to 3 layers of tax. And if you have no planning done, you can in fact be paying double tax. Like in Canada, our top marginal tax rate at the personal level is very high. It's over 50%. It's 53.5%, which I know sounds wild, but it's true. Now, in a corporation, if your tax planning is not done in the right way, when you pass away, you can be double taxed on some of your assets such that you could be paying more than that. You could be paying 60 to 70% tax. But with the right planning, you get an estate planner involved. Maybe you will utilize some insurance policies strategically in a way to build up that capital dividend account inside your corporation. And through some of the numbers that I've been shown, you can bring down that very high tax rate down into the, let's say, 30% range. And then you also have to figure out, okay, if I'm doing this not just for myself, I'm doing this for my family and my loved ones, how am I going to be able to use my corporation to move on those assets to the next generation in a tax efficient way? This is where I think at the right time, something like a corporately owned insurance policy for the right person, because these are very rigid policies, but this is where something like corporately owned permanent life insurance can be a useful way to shift off some of those assets in a tax strategic way. So those are just some of my thoughts about how to do things better today, and then some insights for later on down the road to make sure that our loved ones are served as best as possible too.
Yeah, we could do an entirely separate episode around tax planning of what you just described. It's also obviously it's different in Canada than it is in the U.S., but there's a lot of similarities. It's just I encourage anybody who's trying to dig into this is find a tax strategist.
Yeah, not a CPA.
Not
tax
a CPA,
strategist.
tax strategist.
That's such an important point, guys. Like we need to find the right people. And sometimes I find we just bombard our accountants with everything when we need to have the right people in our corner when it comes to tax planning. So great point.
Yeah.
Can I
I
ask,
thought I had a question. You go for it. Yeah.
while you're thinking about that,
Yeah.
can I ask, I want to ask a follow-up about the corporate-owned life insurance policy, because this reminds me of a book called Seventh Generation Legacy and another book called What Would the Rockefellers Do? And that one is a compare and contrast between the Vanderbilt family and the Rockefeller family, two historical families of enormous wealth. One is a great story and one is a very tragic story about how that turned out. One of the things that the Rockefellers did is that they established what came to be known as the family office, and they used whole life cash value insurance policies to borrow against that would help replenish the family office as you had people that would pass away. And so that really got me looking at the corporate owned permanent life insurance policies. Can you give us you've given us just a tiny little teaser there. Give us a little bit more in terms of what you're looking for in terms of like the product type, the funding, the beneficiary, the owner. Like you said, it's a really strict policy. How is that different than a typical life insurance policy, and how would someone implement that in their portfolio?
Yeah, great question. So somebody asked me about this yesterday. So I'm going to do my best to go through the basics and then touch on permanent life insurance. So I tell everybody, all doctors, you're going to need insurance. The most important type is disability to protect your ability to earn. The second most important is going to be life insurance if you have dependents. Most of us will have a term life insurance policy. That's the one I have right now, but it is convertible to permanent life should I want to. But term life insurance will basically, if you pass away in a certain window of time, it will give you a payout that will go to your dependents, and that will be a tax-free payout. Now, permanent life insurance is different. It does not terminate in a certain window. It will continue to go on, and there are essentially two components to these policies. Before I get into the components, let's just understand permanent life insurance has two subtypes. One, you have whole life insurance, and then you have universal life insurance. Whole life insurance, you just make payments to the insurance company, and then they will be investing some of those funds as per their policies. You don't really have any say into what it's invested in. Universal life insurance, however, you can dictate what the investments are going to be. Do you want them to be more oriented to fixed income or growth? You can pick that. Now, both of these policies, whole life and universal life, which fall into the umbrella of permanent life, they have two parts to them. One is a death benefit, which will go on to the next generation, essentially tax-free transfer. There are some nuances there, but big picture, that's how it works. The second component to these policies is what's called a cash surrender value or cash value, and the mnemonic for that, the term is CSV. So as you contribute to these policies, you have the death benefit that is growing with time, but then you also have the cash surrender value that grows with time. And that grows because the money inside the policy, it is invested in a certain way. And so what some people will do, the most important thing is when you pass away, you've got this permanent life insurance policy that has been built up, and you've got this death benefit that will move on to the next generation in a tax sheltered way. That's different than term life insurance where you're paying every month for 20 years, but none of that's going to go to the next generation because if you don't pass away, you've paid your premiums, you're not getting any of that back. Now, some people in retirement, what they will try and do, and this is where it's a bit of a gray area. I've been encouraged to not use this or not see this as the primary role for permanent life insurance, but they will take a policy while they are alive. Let's say they stop practicing medicine and they'll be like, hey guys, I've got a permanent life policy. It's been funded through the corporation and the cash value is worth this much. Could be $1 million, could be a couple $1 million, depending on how heavily you have funded this. And they will take it to a lender. It could be the insurance company, it could be another lender. And they will say, I want to now use this policy as collateral and I want to take a loan. Often it's a corporate loan, but sometimes people will also use this as a personal loan to fund their retirement. And then what some people will do, it's a bit of a gray area, they will not pay off that loan while they're alive, but they will let that loan ride out. And then the death benefit that is going to the next generation will pay off the loan later on. This is a bit of a gray area, but this is just where permanent life insurance can be quite flexible. Now, I want to make it very clear. I'm 41 years old. I'm mid-career. I don't have a policy like this yet, and I'll tell you why. It's because these policies are not flexible in terms of their funding arrangement. So once you commit to it, you have to keep funding it. If you don't fund it, you're going to run into issues that can lapse. So when you're in a period of your life where you have a lot of cash flow commitments, you've got a mortgage, you're investing for your future, maybe your kids are going to private school, maybe they're going to be going to university, you'll be paying potentially something there as well. You don't want to really introduce something that is inflexible that could impact your cash flow needs. So that's why I don't have one yet. But as time goes on, it's certainly something I would consider for the right reasons. But that is a summary as to why it can be useful. For somebody who's got a corporation, you fund the policy from your pre-tax corporate dollars, and then it can be flexible in its use. Understanding the main use is tax efficient transfer. That's is what I believe in to the next generation. But I hope that's a reasonable overview.
That's
It's fantastic. And sorry, I'm going to jump in. Fantastic explanation and a fantastic justification for why someone may or may not want to do it at this point in their career.
Yeah, I can speak to that. So I actually employ the infinite banking strategy. And the one thing I didn't do it is on the corporate level where it's pre-tax earnings. I whiffed on that one. I see a hole in my strategy there. But you're exactly right. I'll just reiterate this and then I want to move on to another question. But this is something that you either do or you don't do. You don't dabble because you're signing up for several years of needing to heavily fund this. And if you think your life is going to change in the next 2 or 3 years, you're on the edge of a career change or something like that, it's probably not the right time. You have to commit to a 3 to more like a 5-year strategy of overfunding this policy to get the benefit. And then the last thing I'll say is there's something called riders that are really beneficial to look at. Like you've got, we have some high risk health issues on my wife's side of the family. So we have a rider in place that we can use death benefit before we pass away to help with some of those things in the event that they come up. So I would always ask about riders and different things that you can negotiate that may not be transparent when you're first looking at the policy. Besides that, you said way more than I could have, and I've learned a lot. So thank you for that. I'm going to go back.
No problem. No problem.
For the sake of time, we got to start wrapping it up here for the sake of the listeners and for you. We really appreciate how generous you've been. So thank you for that. I want to ask you about something that is, I think everybody knows is real, but I don't know if everybody believes that it's as real as I believe it is because I've seen it firsthand. I worked in the hospital system during COVID when the Delta variant hit. It was a really tragic time, and physician burnout and hospital staffing issues are in a crisis. Mid-career burnout, especially among white coat professionals, is something that is very real. I do think that there is significant risk of patient outcomes being affected by that. You got sequential monotasking. There's focus sprints. You got boundaries. People are forced to practice defensive medicine because of liability. What are some of the routines that have helped you improve your lifestyle, your balance, your judgment as a physician, your judgment as an investor? Like, what are some of the things that have helped you navigate a world that just increasingly seems to have more noise and opportunity for physician burnout?
That's a beautiful question. For me, I got started on this a little bit later in life, but I would say once I hit my early to mid 30s, I started to just become really curious about the world and how everything works. And the philosophy that I try to practice every day is how can I finish this day a little bit better than when I started? I want to treat each and every day as a chance to learn. That's why I myself have just embarked on this journey of learning and education. I know everywhere for us, all physicians out there, somewhere on our personal statement back in the day, we said that we were going to be lifelong learners, right? And for me, I said, I have to practice this. So that's what really pushed me to do what I do with my podcast, Beyond MD. And I would just encourage people, the more that we educate ourselves, the more that we can set ourselves up for success. Because I think where we struggle in medicine is a lot of our identity is tied to being a physician, being a healer. That is not an easy job. And our job is also one that does not really come with full control. In fact, I would say most days we don't have much control over our schedules. So by educating ourselves on topics related to finance, I believe that's a great way. It's been a great way for me to gain a little bit more control in my life. For example, January, I'm stepping down to 4 days a week of clinical work so that I can allow my mind the time and space to breathe and go down my creative pursuits with more intention and focus. But that only happened because for the last 8 years, I was constantly educating myself. I started to invest, I started to try different things. And fortunately, things have been heading in the right direction where I can take a little bit of a step back. What does that do for me? And what can that do for other listeners? It can give you a little bit more control over your day to day. Because I think that's where medicine gets very difficult. And then I would encourage everybody to think along this line. But in medicine, our outputs are directly connected to our inputs. And I learned this the hard way, guys. For 6 years, 2017 to 2023, I worked 6 days a week because I was picking up extra shifts, trying to ramp up my income. I was gaining experience along the way too. But I realized that wow, my outputs are directly connected to how much input I placed into this. I'm constantly trading my time for money. That is not sustainable long term. And that's why I think educating yourself financially is so important, because once you figure out the right strategy for your long term why, eventually you're going to hit a point where your outputs will become disconnected from your inputs. And that's why I think what we're talking about today is so powerful. So those are the last couple points that I would like to leave people with. And I would encourage everybody to try and think like this.
Fantastic. Listen, this has been one of the best interviews we've had in a while.
Yeah, this one was sneaky good.
Yeah,
Snuck up
sneaky
on
good.
us how good this is good.
But all good things must come to an end. We've all got lives. We've got, and so in the interest of time, we're going to ask our final question that we ask all of our guests, which is there a book that you find yourself recommending again and again to friends or colleagues?
I have a lot of books, guys, but this year I would say my favorite book was Die with Zero by Bill Perkins. And it just really drove home the point of, and listen, everything we've talked about today is important. Setting ourselves up for financial success and financial freedom is so important. But at the same time, we want to make sure that with the people we love most in our lives, we want to create those experiences, enjoy those experiences that, and this is how Bill said in the book, those experiences lead to memories, and those memories form dividends that are going to only compound over time because you're going to be sharing stories with people around you. And my most recent experience was if we have time for like a 30-second story, I was the one person in our group practice. We have seasons tickets to the Toronto Blue Jays. I get to go to 1 or 2 games a year. I landed on Game 6 of the World Series. And everybody asked me, they said, what are you going to do? Because it was Halloween night. My kids are like, Dad, are you going to leave us on Halloween night? And I said, guys, listen, I thought about it for a few days and I said, guys, 10 years from now, what am I going to be talking about? Am I going to be talking about Game 6 at the World Series? Or am I going to be talking about trick-or-treating in the streets of Toronto? And then my son looked at me, he's like, Dad, you know what? You're absolutely right. You got to go to the game. And then some people were asking me, well, you could sell the tickets and you could make a ton. And I was like, sure, I could, but I know what's going to happen. I would see that income come in. You'd get excited for like 30 seconds and then you'd figure out, okay, what do I need to worry about next? So that's why I love Die with Zero, because it really helps teach us about balancing living today and also building for our future. So that's why I wanted to leave that book with you guys.
Love it.
What a great answer.
Great answer. Well, one, I'm sorry about you Blue Jays.
Guys, thank you. It's been painful. It's been really painful, but we are proud of them. We are so proud of them. Yeah.
It should be.
Yeah, it's a game of inches, literally inches.
I know.
Now, on that note, Yatin, I can't tell you how grateful we are for your time. We've run a little bit over because I didn't want to stop the conversation. There's a lot of gold through this that I've got that funny conundrum going on where I hate the sound of my voice when I hear my recording, but I want to go back and listen to this at least a couple times. So usually I don't listen to what we record. This one I'm definitely going to. Thank you so much for your time. We really appreciate you being here. If any of our listeners want to connect with you or learn more about your experiences, you've got the Beyond MD podcast, so that very well may be the answer. But what would be the best way for them to connect with you or listen to what you're putting out there and connect?
Well, Neil, Clint, so kind of you guys to have me on here, and I appreciate the feedback. Beyond MD podcast is my podcast. You can connect with me on LinkedIn. That's where I spend a lot of time. And then my new website just goes live this week. It's beyondmd.ca. So you can feel free to connect with me here as well. But Neil, Clint, I really appreciate chatting with you guys. I had a lot of fun today.
Yeah, well, thank you so much. I can guarantee that we did as well. And I'm sure the listeners are going to get a lot out of it, as have I. So thank you very much. We really appreciate your time.
It is a pleasure.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode, leave a comment down below, or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.